Welcome to today's class in Accounting 220. I'm going to answer your questions about the balance sheet and then continue on to another financial statement, the very popular one, the income statement. So as I try to answer your questions, I'm going to do the best that I can. If I misread or misinterpret your question, you can always just email me, drop me a note and say, hey, I didn't mean it that way. I meant it another way. Or if you find my answer unsatisfactory and you want more details, you can always email me to ask for more details. I will do the best I can to help you out. So your questions. So the first question is, what is one of the best uses for cash on the balance sheet? This is actually a very good question that a lot of companies spend a lot of time thinking about. What do we do with our cash? And so it depends on the company's overall strategy, right? So if the company is trying to grow and expand and become bigger and more successful, as small businesses often try to do, then it would make sense for them to take that cash and put it into research and development to try and develop new products, or perhaps purchase a new piece of land to build a new manufacturing facility or a new restaurant or a new building to expand into new markets. So it depends a lot on their strategy. If a company has a strategy of trying to pay off their debt, then they're going to use the cash to pay off debt. But one thing that companies generally don't like to do is to leave the cash just lying there. Because cash just sitting around in a bank account generally does not earn any money. As you know, if you have a savings account or a checking account, usually the interest rates are very small. So if a company has a lot of cash laying around and they don't really have a strategic use for it, generally they'll invest it, usually in short-term investments, in 60-day or 90-day, treasury bills or certificates of deposit, maybe 6-month CDs. They'll invest it in something that's very low risk that will earn them some small amount of interest in terms of the interest rate, but it can add up. If you put, let's say you're only earning 2% on a 60-day or 6-month CD, a 6-month CD, you're only earning 2%. Well, if you put $100 million in there, that's going to be $1 million. 2% for 6 months is a 1% annual return. So it's going to be $1 million in interest, right? So, that's going to be a significant amount of money, even though the interest rate is quite low. So it's a really good question and one that companies spend time thinking about. It's a nice problem to have, by the way. Oh, we've got this big pile of money. Whatever should we do with it? Yes, I would personally like to have that problem in my life. This is another interesting question, right? I have a question about Columbia's balance sheet. And the equity account is labeled common stock. It says there's no par value, but the account has a balance of a little under 2 million. And we have 250,000 shares authorized. So let's take a look at that. I pulled up Columbia's balance sheet over here. You can see that I have Columbia Sportswear up here. And so we got a couple of issues going on here. First, let's be clear about what the student is asking about. They're asking about why common stock has an account balance of 2 million. Well, first of all, the common stock doesn't have an account balance of 2 million. So if I highlight common stock and bring it straight across, right, you can see that the 1993628, which is the number they're referencing right here, that number is actually in the row below, which is retained earnings. And so I do this all the time. I can't tell you how many times I've done this. When my eyeballs go across the page, even though they have it color coded so that you would think, oh, common stock is in a white row and it's in between two blue rows, so that should help my eyeballs kind of go across and get the right numbers. It doesn't. I do this all the time where I will just drop down a row and get the wrong number. So we're just going to ignore that part and talk about the question of the core is common stock. Now with common stock, you have three values. You have shares authorized. When a company decides to become a corporation, they must file articles of incorporation with the state in which they are incorporating. And part of the articles of corporation, it's like a constitution for the business, if you will. It lays down all the rules that the business is going to follow. And one of the things that's going to be in that constitution or in that corporate charter is the company's going to list how many shares of stock that they can sell. In other words, that they're authorized to sell. And so that's where that first number comes from. The 250,000 shares is how many shares they could sell. But that doesn't mean they sold them. The sold number is the issued shares, right? So the issued shares are the sold shares. So this company actually sold 65,164 shares of stock. Now, why don't they have a number here, right? Why is there no number here? When we come back up here to the top, one of the things we're going to notice is right over here on the left-hand side, Columbia is listing all of its numbers in thousands. So that means when you look at their cash and cash equivalents here for 2021, it says 763,404. That doesn't mean they have $763,404 in their bank account. That's not what that means, because this number is in thousands. So that means you got to put 3 zeros behind that number. So you put 3 zeros behind all of these numbers on the balance sheet. So this really means that they have $763,404,000 in the bank. Not 763,000, 763 million, because this says in thousands. So that means if they just had the number 4 here, that doesn't mean it would be $4. That means it would be $4,000. And over here for short-term investments in 2020, it doesn't mean they have $1,224. It means they have $1,224,000 in investments. Okay, so that's might be what's confusing here. So when I come down to common stock, if they have less than $1,000, then they'll just leave it blank, right? In other words, if it rounds off to zero, if you had like $450,000, excuse me, if you had $450, well, rounded, that's not even 1,000. So that would just be zero. So that would be why there's a line here and why it's zero in that account. Now over here, you can see they have 20,165,000. Now the student also asked about no par value. The no par value just means they're incorporated in a state where there is a no par value law, right? There's not, in other words, there's not a par value law is what I should say. Par value is a legal term and it does affect the accounting, but it doesn't affect the amount of money they get for selling the stock. It just affects the way they have to classify it on the balance sheet. So don't worry about that part. That doesn't have anything to do with the numbers. Okay, that's neither here nor there. So I hope that answered that question a little bit. If it didn't, let me know. Why do some companies combine current and non-current liabilities and some companies keep them separate? So this is another interesting question, right? While companies are required to file a balance sheet with the Securities and Exchange Commission if they want to sell stock inside the United States, there's no format that they are required to follow for the balance sheet other than it has to be a balance sheet. So they have to have assets equals liabilities plus equity. But how they break down their assets or how they break down their liabilities, there's no rule that says they have to do it a certain way. Now you'll find as you look at more and more financial statements that most companies tend to follow each other, right? They all tend to have this general way they do it, but you will see exceptions. And so the answer is because some companies want to do it and some companies don't want to do it. That's basically it. So I know that's not a very satisfactory answer, but that's what it is. I remember learning about paid-in capital, but would like to re-jog my memory on what it is. I'll just use Columbia's balance sheet here, okay? So paid-in capital refers to an equity issue. Anytime we're talking about capital, we're talking about equity. So the equity section is broken into 2 basic parts. Now this Columbia doesn't show it this way, but you'll see companies that do it this way. They have what is called paid-in capital, and the reason it's called paid-in capital is because it's cash capital and cash are synonymous here. It's cash that's paid into the business by the owners in exchange for shares of stock. So if I give Columbia, $1,000 in exchange for so many shares of stock, Columbia would take my money and put it in paid in capital in the equity section of the balance sheet, because that's money I gave them in exchange for shares of stock. So anytime owners are paying money into the business, it's called paid in capital because the owners are paying the money in. The other part of the equity section of the balance sheet will be called earned capital. And this is called earned capital because it's money that's not been paid in by the owners, but it's been earned by the business. In other words, the business is operating, they're making money, they're making profits, and those profits go into the earned capital section of the equity section on the balance sheet. And this account in the equity section is called a retained earnings. This is an earned capital account, okay? So in accounting, companies are required to separate in their equity section paid in capital from earned capital. Now, some companies will just say paid in capital, and then they'll have preferred stock, common stock, because all the stock accounts are paid in capital. And some companies will they'll have an earned capital section, which they'll call retained earnings. Columbia doesn't do this, and a lot of companies don't, because if you've been around accounting and finance long enough, you know that preferred stock and common stock are paid in capital and retained earnings is earned capital. And so it's sort of common enough that everybody sort of knows it unless you don't happen to know it. But some companies will do it that way, but that's all that means. Paid in capital is just money that's been paid into the business by the owners in exchange for stock. Kroger. Does Kroger own goodwill since it's in their asset on the balance sheet? Does Columbia have goodwill? Yes, Columbia has goodwill. So I'm just going to use Columbia, even though it's going to be the same for Kroger. In the asset section of this balance sheet, you have an account called goodwill. Okay, and the question is, well, what is goodwill, right? Goodwill, when you think about it from an English point of view, goodwill sort of seems like, kind of like a feeling. If I have goodwill towards my neighbor, that means I'm gonna treat them well. I'm gonna try to be kind. I'm gonna try to help them out if they need it. I'm gonna be nice. So a lot of times when we think about goodwill, we think about feelings and maybe how we treat people, and that doesn't make any sense in the context of a balance sheet, right? So what is goodwill in like accounting and finance? Goodwill is an account that you don't really own. Okay, goodwill is an intangible asset. The word intangible means that you can't touch it. The word tangible means to touch, and the prefix in means not. So intangible means you can't touch it. That means you can't touch the thing that has value, right? It's not something that you can kind of put your hands on. So like if I look at Columbia's balance sheet, right? Cash, yeah, I can get my hands on cash. Inventory, yeah, I can put my hands on inventory. Property, plant, and equipment, that's like land, buildings, equipment. Yeah, I can put my hands on that. But then you have this other category down here called intangible assets. Now, intangible assets would be things like copyrights and trademarks. Like if you're a musical artist, maybe you have a copyright on lyrics that you've written. Or if you're a restaurant like McDonald's, you've trademarked the golden arches so that no other restaurant can kind of use that symbol. That's kind of yours. Goodwill is a type of intangible asset, but it's created through the company purchasing another company. So like if Columbia buys another company, and then that other company becomes like part of Columbia now because Columbia bought them, then in the course of purchasing that other company, in the accounting, in terms of making the journal entry and getting it into the accounting records, goodwill may be created during that transaction. So the short of this is that goodwill is a specific topic that's covered in advanced accounting classes like 400 level, senior level classes, and graduate level classes in accounting, because it's a complicated idea in that it arises when businesses are purchasing each other. And that's not what we study in Accounting 220. We don't study that topic. We study businesses like selling things to customers or maybe purchasing inventory from another business. But we don't study businesses like purchasing other businesses. So goodwill it's not really something that's owned in the sense like you can pull out like a title or a receipt to say that you bought it. That's not really what that is, but it is an asset on the balance sheet. And it's intangible. It's not like a piece of equipment or a shirt that I could sell to someone, right? It's something that's sort of nebulous and abstract. So it's there. Don't worry about it. You're not going to see it from me this semester at all on any kind of, exam or anything like that. So it's there. Wave at it. And if you're an accounting major, you can say, hey, I'll see you later. Why doesn't Lulu have total assets, total liabilities, and total equity specifically labeled and next to other non-current or other current assets instead? It made the balance sheet harder to read. I have no idea. So let's go back here. Let's go back here and see if I can find Lululemon. And let's get to their balance sheet because I'm not aware that they do this. So as I mentioned, not all companies are required to do it the same way. So when you ask me about the way a company does something, I got to go look it up because I don't know. So what was the question again? Why don't they have total assets? Well, they do have total assets, right? So if I look at Lululemon's balance sheet, right, we're here at Lululemon Athletica, and they have their asset section here, and they have current assets, and you can see they have stuff similar to Columbia, and they have their totals. And then notice down here, they total it up, right? Their total assets is 4,942,478. Now they're in thousands also up here. So that means I'd put 3 zeros behind that. So that's not $4,942,478. That's $4,942,478,000. But they don't have the word total asset here. And I don't know why they don't do that. It seems kind of, I don't see the point, I guess is what I'm saying. It's obviously your total assets. So why wouldn't you just take the time to type in total assets here, right? And the same thing with total liabilities. Notice they don't type in total liabilities here at the bottom of the liability section. And then they don't do total equity or total liabilities and total equity. So I see what the student is saying. And yeah, if you don't know that's total assets, once you've looked at a few financial statements, it'll be obvious to you that that's total assets. But I'm not sure what the purpose is by not putting it in there. That seems sort of pointless. I mean, you've already typed all this stuff in. Why not just type total assets in? It's, it's just a few more letters. So it's not like it's a big deal. It's not like you're writing a 10-page essay here. You're just typing in 2 words. So the answer to that question is I have no idea why Lululemon does this. They have the information there and you can figure it out. But I agree that, why make it more complicated than you need to? Just put total assets there, right? That way, if you have somebody who hasn't looked at this stuff before, they'll know. Why do companies break down all their accounts on the balance sheet when we mainly just use the totals? Well, your answer is in the question. The answer is that we don't just use the totals. Now, that's what you're doing for your first assignment in Accounting 220. But a lot of financial investors and a lot of financial statement analysts and banks and other people who use these financial statements don't just want the totals. They want to know specifically about how much money the company has in the bank. They want to know specific information about their inventories. They want to know specific information about their debt, right? What kind of debt do they have and when is it coming due and how much is coming due soon and how much is coming due later because that debt has to be paid, right? And a lot of analysts will use a lot of these numbers to create statistics, if you will. We call them like ratios in finance and accounting. But they're creating statistics that they can use to compare to other companies. So the answer here is that they don't just mainly use the totals. In fact, most analysts don't really look at the totals. They look more at the details. So we're doing just the totals here in 220. But if you want to learn more about the details and analyzing the details, like for instance, would this be a good investment in terms of buying the stock of the company? These are things we talk about in upper level accounting classes, and I'm sure you cover in upper level finance classes as well. With Apple being a multi-billion-dollar company, how does this sheet with annual numbers show numbers only in the hundreds of thousands? So I'm going to come back here, if I can come back here, and let's look up Apple. So let's come here to company search and let's find APPL as Apple. And let's go to their 10K here. And let's see what they've got. Okay, I just want to make sure I'm looking at the same thing, so I'm answering as clearly as I can. Here's the balance sheet. Okay. So let me go back to the question now. With annual numbers, show numbers only in the hundreds of thousands. It feels like the total number would be a lot higher. So I guess you're talking about like Apple's total assets, right? Apple's total assets is $352,755. And I'm guessing the question is your instinct says, that's not a lot. I mean, $350,000 is a lot of money to me anyway. But to Apple, that doesn't seem like a lot of money for as big as they are for a worldwide technology company. And the answer is you're right. And this goes back to what we talked about earlier. Notice when I come up here to Apple's consolidated balance sheet, it says all the numbers are in millions. Now notice that Columbia and Lululemon were in thousands, but Apple's is in millions. So that means you don't put 3 zeros after the number, you put 6 zeros after the number. So for instance, for cash is $23,646. That doesn't mean they have $23,646 in the bank. That means you put 6 zeros behind that number, and they have 23 billion with a B, $646 million in the bank. So that means their total assets are $352,755 million of total assets, right? So whenever you're looking at a company's balance sheet, it's important to kind of glance up here at these little details and say, hey, are these numbers kind of raw? Because some companies, they'll just be raw numbers. When they say 2,000, they mean 2,000. When Columbia says 2,000, they say our numbers are in thousands, so you add 3 zeros behind it. So when we say 2,000, we mean 2 million. And Apple says our data is in millions, so you add 6 zeros behind our numbers. So when it says 2,000, it really means 2 billion with a B. So yes, you are correct, and your instincts are right on. If you didn't catch that little detail and you look at these numbers and you go $352,000, that doesn't make any sense. Right? No way. And you're right. Okay. And yes, to be kind, you weren't reading it completely wrong, right? You had the right numbers there. You just missed that little detail, I think, at the top. So a good point, though, to pay attention to those things. What's the difference between long-term and short-term investments? In accounting, the difference between long-term and short-term is 1 year. So anything that is 1 year or less is a short-term investment. So in other words, if I have an investment and I plan on selling it, or it's going to mature, or I'm going to cash it out within 12 months or less, then I would put it as a short-term investment. If it's something that's going to be more than a year, it's a long-term investment. And that's the same thing for liabilities too. If I have a liability that I'm going to have to pay within a year, it's a short-term liability. If I'm not going to pay it for more than a year, it's a long-term liability. So short-term, long-term in accounting is just a year. That's the dividing line. The thing that confuses me the most is how to tell when to use what accounts in each part of the balance sheet. I'm not sure how to answer this. I understand the confusion. I'm not sure if you mean you don't know, if you're talking about how do I know that cash is an asset, or if you're talking about how do I know that cash is a current asset. So I don't know if you're saying, how do I know which accounts are assets versus liabilities versus equity? Or how do I know, like within the asset section, how would I know which ones are current assets and which ones are non-current, right? So I'm not sure what level you're asking about, maybe both. And the answer is with experience, right? So as you look at more companies' financial statements, as you work more problems in accounting class, you will begin to become more familiar with where things go. I can tell you that I don't know where everything goes, right? Because I don't know every account that every company uses because I haven't looked at every company's balance sheet that exists. I mean, we're talking about hundreds of thousands of companies, right? So I know all the common ones and I know a lot of the uncommon ones, but I'm sure if somebody dug around on some obscure company's balance sheet, they could find an account and show it to me, and I may not have any idea for sure what it is. I mean, I could guess. So the answer is you work problems, you look for patterns, you ask questions and you learn, and you learn as you go. And so that's often what makes accounting difficult, is you just kind of got to learn it as you go. You just got to work at it, right? It's kind of like learning how to cook, right? I can't expect to go into the kitchen my very first day and, be a world-class chef, right? I'm going to make mistakes. I'm going to screw up, and I got to get experience. I got to try stuff and mess up and burn stuff and not cook it long enough and use too much salt and basically just screw it up a whole bunch, and then maybe start reading about better cooking techniques or watching videos or taking classes and gathering more information and knowledge, and then I'll get better. And the rate at which I get better is largely determined by the amount of effort I put into it, right? If you never put any effort into kind of studying this stuff and trying to recognize patterns and learning as you go and asking questions and working practice problems, then yeah, it's all going to be confusing to you probably forever, right? But if you just dive in and start making mistakes and messing up and asking me questions, and you're going to get better. You can't help it, right? If you put effort into it, you're going to get better at it. So put effort into it. There's no magical formula. There's no list. It's just dive in and learn. So just dive in and learn. Can the numbers fluctuate majorly from year to year? Businesses hope not. One of the things that businesses want is they want people to invest in their company. And the way that you get more money invested in your company is to show profit and to be somewhat predictable, right? You don't want to be really unpredictable, because large fluctuations indicate instability and indicate unpredictability. And people don't like to invest their money in situations where it's unpredictable, right? I mean, think about if you had a friend or you were in a relationship with someone who was, extreme bipolar. If they're off of their meds, right, their behavior is going to fluctuate really wildly, and it's going to be very unpredictable. And so that's going to create a sense of kind of trepidation and risk, right? Because you're not really sure how they're going to react, right? They might be super sweet, and then they might be, screaming with a murderous threat towards you, and just flip the switch. And so, that can be kind of unnerving and unsettling. So the same thing with investing in companies, right? If I'm going to invest my money with a company, I want to be, there's always risk, but I want to be reasonably confident that there's not going to be any major changes in the company. Now, I'll take major good changes, but the problem with taking major good changes is you got to take major bad changes. So investors generally don't like investing in companies that do the roller coaster with their numbers. They have the real high highs and the real high lows. They prefer the nice steady incline, right? You're just steadily going up over time and making nice returns year over year. So yes, the numbers can fluctuate wildly, but it's not certainly desirable from a management standpoint. Okay, so what I want you to do for your next assignment is do kind of what we just did, but we're going to do it with the income statement. So I'm going to use Costco again. So I'm just going to show you how to do this real quick. So I'm going to come here to a company search, and I'm going to search for Costco. You can't use Costco because I do. It's my company, right? It's my special company. So too bad for you. Come here, and we're going to come down to item 8, which is the financial statements. This time we're going to call it consolidated statements of income. So make sure you take the income statement, not the comprehensive income statement, just the income statement. Sometimes companies call this a statement of income. Sometimes they call it the income statement. Sometimes they call it a statement of earnings. They'll have the word earnings there instead. But whatever it is, just click on it, and you'll know you're in the right area when you see revenues and expenses. So this is not a balance sheet. We're not doing assets, liabilities, and equity. We're doing revenues and expenses. Revenue is money that the company has earned, and the expenses are the cost that the company has incurred to earn that money. So the basic idea here is that earning money is not free. So if you're Papa John's and you want to earn money, you're going to have to sell pizzas. To sell pizzas, you're going to have to make the pizzas. But making pizzas is not free. right? You're going to have to buy the ingredients to make the pizza, the dough and the sauce and the cheese and the toppings and so forth. You're going to have to buy an oven to cook the pizzas in. You're going to have to buy a box to put the pizza in. You're going to have to buy some kind of cutting instrument to cut the pizza up into slices. You're going to probably have to pay employees to do all this. You're going to have a store that you sell your pizzas out of so customers can come in and pick up the pizza. You're going to have to pay for electricity and gas to run the lights on the store and the gas in the oven or whatever the case may be, right? So you're going to have a lot of cost in terms of earning your money. So you have your revenues, the money that you've earned, and you've had all the costs as a business that's helped you earn that money, right? Because earning money is not free. So what we have here is for Costco, you notice we have 3 years of income statements. If you remember, the balance sheet only had 2. So there's 3 years of income statements. And what I want you to check on here is I want you to put for 3 different companies again. It can be the same 3 companies you used before, or you can pick some new companies. I don't care. Just pick 3 companies. And this time I just want you to pick one revenue account that the companies have in common, just one revenue account. And then pick 2 expense accounts that the company has. And then I want you to ask a question. Okay, so we're doing a little bit less than we did for the balance sheet. So 1 revenue account, 2 expense accounts that your companies have in common, and then ask a question about something that you see on the income statement that might be confusing to you or you just want more information about. Okay, I'll repeat these instructions up on Blackboard, and this will be due tomorrow evening, so the evening before the next class. So if this is a Monday, for instance, it'll be due on Tuesday night, but it'll say that in the assignment prompt on Blackboard. So continue to ask me questions. You're asking good questions, insightful questions. Let me know if you have any questions about anything I've talked about today.